Welcome to part 2 of the best cryptocurrency trading course for beginners. Yes, my goal when creating this course was to make it for free and to make it better than the cryptocurrency trading courses that you could buy for thousands of dollars. So in this week, we are in week 2 or part 2, and we're talking all about charting, where I'm going to teach you about support and resistance, about trends, about the different market phases, about my 3 favorite different chart patterns. If you missed last week's video, then go back in this playlist and you'll be able to catch up on the crypto basics. The 3rd video coming next week will all be about crypto indicators. I'm going to talk about why most indicators are BS and the only indicators that you should really pay attention to. Then we're going to be covering trading systems, our favorite trading strategies, and trading psychology. So with all that being said, let's dive into what we're actually going to be covering here today. Number 1, we're going to be talking about support and resistance and how to identify accurately support and resistance. We're going to be talking about the different market phases, which is incredibly important. We'll talk about trends and how to identify trends. We'll talk about using candles, which we learned about in the previous video, and how to combine them with things like support and resistance. We'll talk about different chart patterns, and then next week we're going to follow up and we're going to start talking about indicators. Now, to dive in, we're going to be talking about support and resistance. And to understand support and resistance, you first need to understand that there's different types of support and resistance. The most common is what's called horizontal zones, which I'll show you in a second. We also can have support and resistance off of trend lines, and we can also have support and resistance off of moving averages. What is support and what is resistance? If we take a look, support and resistance basically means support acts as like a floor that price tends to bounce off of, and resistance acts as like a ceiling that price tends to bounce off of and has trouble breaking through. So generally, these are what are also called key zones or key areas that you want to look for in trading. And essentially all they are is they're areas or zones where price basically plays off of. They're key areas. And a lot of the times these key areas of support and resistance are actually whole numbers. So in this case, you can see like around $60,000 here is like a key resistance zone in this territory, meaning that we saw price come up to here once. We saw price kind of struggle around here again. We saw price in this zone multiple times, price in this zone a lot, price in this zone a lot, price coming up to this zone and struggling again. So this is a key zone, meaning that price tries to, interacts with this zone quite a bit, okay? Also, we can see key areas here. This was a key area of support, right? We saw price kind of fiddling around here, hit this zone and kind of came off sharply, hit this zone multiple times, came into this zone, bounced off sharply, came into this zone, rejected it quickly, came into this zone, came into the zone again, came into the zone, rejected it quickly, came in, touched this zone, rejected quickly. So this is another example of what would be called support. Support is like on the lower side and resistance is like on the higher side. So support is like a floor that price bounces off of, and resistance is like a ceiling that price bounces off of. And you can see there's also multiple zones on this chart. There's not just 2. You can see here was a key area of support as well. And one thing that you'll notice a lot of the times is that key areas of support in a trend can often form areas of resistance. And I'll get into that when we're talking about trends later on, but this is a little bit subjective on how you draw support and resistance zones, but I'll show you how I like to do it. So if you're having trouble drawing support and resistance zones, one thing that might actually help is actually, instead of looking at a candlestick chart, actually looking at a line chart. And if you do that, sometimes it's a little bit easier to see where these key zones are. Like you see, this is definitely a key zone here, right? We saw that price rejected this area multiple times. And what do you know? It happens to be kind of a round number, $40,000, right? It rejected here. It's rejected a whole bunch of times here. It's rejected here. It's acted as support here, right? So you see that this is kind of a key zone here. It makes it a little bit easier. We can also see kind of right around here is another key zone where price likes to reject off of, and it also turns into support. So sometimes switching from just a candlestick chart to a line chart can help you find support and resistance. And again, support and resistance isn't a completely 100% accurate thing. It's somewhat subjective, but using a line chart can help you get better areas to draw support and resistance at. The next type of support and resistance are what are called trend lines. So you can see here, I've drawn this trend line. We can see that there's this trend that's popped up right here. And you can see that price, when it comes to this zone or this trend line, it tends to bounce off of, right? It bounced off here once, bounced off here twice, bounced off here 3 times, right? So this is an example of a trend line. that acts as support and resistance. Okay, another example, here's a downward trend line here, and we can see that every time it bounces off of here, it seems to bounce off quite sharply. And here's one more example of a trend line support. In this case, it's came down, it's bounced off sharply, came down, bounced off sharply, came down, bounced off sharply again. Now, the last common type of support and resistance are what's called moving averages. And if you're not familiar, we're going to cover moving averages a lot more in depth in the next video, but it's an indicator that basically shows you the average price of a set of data. And if we look at here, we can see that this line drawn on the chart, we can see many times that the price will come down into this moving average and it'll bounce off. As you can see, it came down here, bounce off, bounce off, bounce off, and then it started acting as resistance, bounced off, and then it started acting as support. And so this is another way that you can find support and resistance. Now, the next thing that we want to talk about is the market phases. And this is important when you're trading because depending on the market phase will determine how you want to trade. There's three main different types of market phases. There's a ranging market phase, there's what's called a choppy market phase, and then there's a trending market phase. So let's get in and let's take a look at each three of these. Okay, so first things first is a trending market phase, which basically means prices moving in one direction quite sharply. So as you can see, we were in quite a trending market all the way through here. We saw that, price was continuing to move up, up, and up. And it could take a third grader to see this, that if you just ask, hey, from here to here, what was happening with price? It was moving upwards, right? It doesn't really take a whole lot to understand that. Generally, you're going to see what are called higher highs and higher lows, which we're going to talk about in just a second, but it's really easy to identify this. The next type of market phase is what's called a ranging market phase, which basically means that price kind of just floats around inside of this range. So you can see here was kind of like a ranging market phase where price would come down to this lower end of the range, and then it'd come up to the top end of the range. Then it'd come down to the lower end of the range, and it'd come up to the top end of the range, and it'd come down to the lower end of the range, and it kind of bounces in a range going up and down in these areas of this range. And then we also have what's called a choppy market, this is the third phase of the market, which we can see kind of like right here. This is really choppy, and it means that price is really compressed and it's kind of just in this untradeable area. You really don't want to be trading in a choppy market generally, unless you're trading some sort of like mean reversion strategy, which we're not going to cover right now. But essentially, price is not really making any beautiful or any big moves. It's kind of just in this choppy zone. Now, the thing to understand about the market phases is the market will always go from trending to ranging, and then from ranging to trending, and then from trending to ranging, and ranging to trending. And it consistently goes back and forth. And generally what happens is when we go from like a ranging market or like a choppy market, these are kind of similar in a sense. Just a choppy market is just a smaller, really tight range, I would say. But once you have this really tight range, like right here, generally what happens is the longer we see the market in a ranging phase or a choppy phase, that means that there's likely going to be a large breakout or a large trend that comes and follows, which we're starting to see right now happening on this Bitcoin chart. So these are the three different types of the phases of the market. They constantly switch from a ranging market phase to a trending market phase. So if you're in a really long ranging market phase, that likely soon there's going to be some sort of big trend. The next thing that we're going to talk about is trends. Okay. Now there's a few ways to identify trends. One is drawing a trend line, which we talked about earlier, where you're basically just connecting the bottoms in an uptrend, or you're connecting the tops in a downtrend, just like this. This is the first way that you can identify trends, is just by drawing a simple trend line, okay? The next way that you can identify trends is by what's called structure. Generally, in a trend, you're going to see something called higher highs and higher lows in an uptrend. And in a downtrend, you're going to see lower highs and lower lows. So let's dive into the chart and actually take a look at what this actually means. Okay, so in an uptrend, we're generally going to see higher highs and higher lows. Now, what does this mean? So this basically means that, okay, here we see that, okay, clearly the chart's kind of just moving upwards kind of gradually for the majority of this phase of the market, right? So here was the previous high. So this is a high, and then this is the low, right? And in a trend, it kind of moves in this period where it breaks out and then it kind of pulls back. Then it comes out and it pulls back, and it comes out and it pulls back, comes out, pulls back, right? So this is kind of the way that the market works in a trending market. Okay. Now, what do we mean by higher highs? This means this was the previous high and this is the next high. This means that this is a higher high. Okay. And in an upward trending market, we're also going to see higher lows. So this was the low, and then the next low was like right here, right? So there's a higher low, there's a higher high, and there's also a higher low, okay? Coming up here, we also see it came up all the way to here. This is a higher high than the previous high, and then this is the low. This is a higher low than the previous low. Okay. Now in a downward trending market, we see just the opposite. We're going to see lower highs and lower lows. So let's take a look at this, for example. So this was the previous high. This was the high here, and then this is the next high right here. So this is a lower high than the previous high. So it's a lower high. Okay, this is the low, and then this is the next low right here. So this is a lower low than this previous low. Okay, so the market moves in this phase in a downtrend. It has higher lows continuously and has lower lows continuously. So the next thing that we're going to talk about is chart patterns, which essentially are a pattern that basically encapsulates the psychology of what's happening in the market. Remember, the marketplace consists of buyers and sellers, and a chart is really just a visual representation of the psychology of the market participants, which is buyers and sellers, right? So I'm going to show you my 3 favorite chart patterns. There's a lot of different chart patterns out there, but these are the 3 most important chart patterns that you want to use in crypto. Okay, the first chart pattern is called a double top and a double bottom. The second chart pattern is called a head and shoulders and an inverse head and shoulders. And the third type of chart pattern is called volatility compression. So let's go ahead and let's dive in and let's take a look at what this actually means. So a double top and a double bottom, okay, a double top and a double bottom, they're just the reverse of each other. But basically, it's really self-explanatory. There's 2 tops. You can see it easily here. Price comes up to here. It rejects, comes back down to what's called this neckline. Then price comes up to here again. And the market's basically saying, hey, we already rejected that price again. And if it rejects it again, then it's pretty clear that price doesn't want to go to this price and it wants to fall lower, meaning the market participants don't want to buy anything kind of above this range or above this level right here, which could also be a key resistance range, a key resistance zone, right? And then price starts to come down here. So how you want to trade this is you want to enter kind of right around the neckline, which is this line right here. And you want to put your stop loss somewhere up above here, and you want to put your take profit somewhere down here, right? Now, double bottom is just the opposite, right? It's basically saying that it comes down here, price was rejected from this price right here, comes on up to this neckline, it comes back down to retest this level right here, and it rejects again. So we know that this is an area where price doesn't want to go right now. So you basically enter right around this neckline, you put your take profit somewhere up here and your stop loss somewhere below the neckline, or you could even put it, if you want to be extra safe, below the structure here, below the double bottom, or in this case, you could put it above the double top. So let's go ahead and take a look at this on an actual chart. Okay, so here's an example of a double bottom. You can see here, prices came all the way down here. It rejected this zone. It comes up here, it forms the neckline. It comes all the way down here. And another thing is we saw these like long wicks, which is also another good sign, but we saw the double bottom come up here and boom, it breaks off past the neckline and then it continues on upwards. Now here you can also see an example of a double top, right? So you see price came up here. It didn't want to go any higher. It came back down to what we call this neckline right here. Price tried to go up, boom, again, and it did not want to go that far. And then price rejected, meaning that price doesn't want to go that high, and it comes on and starts falling down. Now there's also what's called a triple top and a triple bottom, which is basically the same thing, except for price rejects this top area 3 times in a triple top, and price rejects his bottom time 3 times in a triple bottom. Now, the next chart pattern that we're actually going to talk about is something called the head and shoulders. And essentially what this means is there's like this head here, price comes up, doesn't want to go, comes back to the neckline, price goes up even higher, okay? And it forms like this head, comes back down to the neckline, comes back up to here to this previous shoulder or somewhere around the previous shoulder. It's not always perfect. And then price comes on and starts falling back downwards. This is called a head and shoulders pattern. And an inverse head and shoulders pattern is just the exact opposite. Price comes all the way down here, comes back up to the neckline. We form the bottom of the head here, the upside down head or the inverse head, comes back to the neckline, and we form the other side of the shoulder, and then boom, price takes on off. So let's take a look at these in actual charts. So here on the Bitcoin daily chart, we can actually see a head and shoulders pattern. We can see it coming up here, boom, there's this shoulder, comes down to this neckline, right? Comes back up, here's the head, it's higher than the shoulder, comes back down, it broke the neckline slightly, but then it came back to form this other side of this shoulder, comes back here, and then boom, price went all the way down. Okay, so this is a head and shoulders. Okay, now here's an example of what we could see as an inverse head and shoulders. So we saw that the shoulder formed right here, price went down here, didn't want to come back up a little bit like this. Then it came down, went even lower and formed the head here. Didn't want to go there. Price came up, price came back down to form this other shoulder, and then price took on off upwards to this area here. So this is an inverse head and shoulders pattern. Now, probably my favorite chart pattern is what's called a volatility compression pattern. Some people will call them triangles or wedges, but basically what is happening is price starts to get compressed into like this compression pattern. So we can see here that price goes up, goes down, up, down, up, down, but every time it goes up and down here, it's getting tighter and tighter, meaning that price is compressing, meaning that people don't know which way the asset should move, up or down, and it's getting tighter and tighter. And generally what happens after a volatility compression pattern almost always is we see a large breakout come after a volatility compression pattern. Okay, so it could either break up to the upside or it could also break down to the downside. And it's hard to tell a lot of the times, but anytime you do see a volatility compression pattern forming, generally you're going to find a really nice breakout trade to happen. And when it starts to break out, basically you'll enter, you'll put your take profit somewhere further along, and you'll put your stop loss kind of below this volatility compression pattern. Okay, so let's take a look at this volatility compression pattern that happened on Bitcoin not too long ago. We can see it kind of forming right here, okay? This is the volatility compression pattern. We see that what's happening, that price is moving up, it's moving down, moving up, moving down. But as you see, it's starting to compress and get tighter and tighter and tighter and less volatility, and it's getting really tight. And then boom, what do we see? We saw this nice breakout come right after the volatility compression pattern. And what I like to think of this is basically, I heard this from my partner who's been trading Bitcoin since it was a penny basically, but he described it as, if you think about when you like ring a bell, you ring it and there's like this really big noise pattern that happens like boom, and then it rings out, right? The sound rings out and it gets less and less and less and less and less and less, and the frequencies become less and less. And the same thing happens like if you were to drop like a big rock in like a pool, right? For example, it has these big waves, right? And they flow out and then they get smaller and smaller and smaller and smaller. And that's what happens kind of in a volatility compression pattern. After there's like a big move, price kind of rings out and it kind of becomes smaller and more compressed, and then boom, then you can knock it again. Like for example, if you're playing a gong, for example, or like a bell, you can't just knock it and have these huge moves. You have to knock it and it makes this big move, and then you let it ring out and it kind of condenses and compresses, right? So that's the idea behind the volatility compression pattern. So in today's video, we covered support and resistance. We covered the market phases, how to identify trends. We identified the 3 most popular and best chart patterns. And in the next video, we're going to be talking all about indicators. Now, there's something you should know about indicators. The sad reality is most indicators are BS. I mean, they don't really help you at all. They're just telling you what happened with price in the past, and most of them have no predictive future or predictive power to tell the future. So we're going to be talking about our favorite indicators. So make sure that you have some sort of predictive power. So make sure that you like, subscribe, turn on the post notifications, and you don't miss the next video in this series.